In this video, we are going to talk about the top 5 ways millionaires invest their money. So before starting this video, please like this video and subscribe to our channel for future updates. According to a study, self-made millionaires were more likely to include equity investments in their investment portfolios, whereas those who were born affluent often had more real estate interests. Many millionaires believe that diversifying such investments is essential. A millionaire's principal residence, mutual funds, equities, and retirement accounts are just a few of the locations they invest their money. Millionaires concentrate on investing their money in areas where it will increase. They take care not to put a lot of money into things that will lose value. For instance, an automobile used for daily transportation will probably depreciate over time. Most millionaires find that saving money before spending it is the key to success. No matter how much money they make annually, the majority of millionaires invested where it will grow, typically in stocks, bonds, and other safe investments. You might be shocked to learn that there are many millionaires among us, despite the common misconception that they are a rare breed. According to the Credit Suisse Global Wealth Report, the United States will have more than 24.5 million millionaires by 2022, or nearly 9% of the adult population. Perhaps one day, you will join this group. It can be simpler than you think to become a millionaire, especially if you start thinking like one. Here's the list of top 5 ways millionaires invest their money. So let's start. Number 5. Avoid a lot of debt. The majority of people deal with debt on a daily basis. But debt can prevent you from making investments. You need less money to invest, the more money you have to pay off debt that has already accrued. Pay off as much of your debt as you can. You can begin paying off your debt in a variety of ways, including the debt snowball and debt avalanche approaches. Any remaining funds after normal costs can be used to make investments after paying off debt. Of course, making the distinction between debt used for an investment, like a house, and debt used for purely spending is beneficial. If they can afford it comfortably, many wealthy people purposefully use debt to buy assets that appreciate in value, like homes. Number 4. Taking some risk may be necessary. Some investors could put more money into stocks and assets with the potential for a high return because they want to make as much money as possible as quickly as feasible. Generally speaking, the potential return increases with risk. But not everyone is suited for investing in high-risk securities, especially when high risk entails a significant potential loss. By moving slowly and steadily, it is still possible to become a millionaire. You can select exchange-traded funds, ETFs, and index funds with lesser risk and keep adding to your portfolio. Include it in your monthly budget so that you may handle it like a bill and not just a passing notion. It's not just the lower risk option, it's also the more likely one. Over time, the S&P 500 index, which is made up of hundreds of the best companies in America, has produced yearly gains of approximately 10%. It's a wonderful place to start for novice stock investors. Number 3. Investing only in intangible assets. Stocks and bonds are typically the first things that come to mind when people think about investing and investing techniques. These investments are not always the greatest, regardless of whether this is because of greater liquidity or a lower entry cost. On the other hand, the value of tangible assets and allocate their funds accordingly. Individuals who are extremely affluent often invest in assets like land, gold, private and commercial real estate, and even works of art. To offset the volatility of stocks, real estate remains a popular asset type in their portfolios. Even though it's crucial to invest in these tangible assets, smaller investors frequently steer clear of them due to their lack of liquidity and greater investment costs. The ultra-wealthy contend that holding illiquid assets, particularly those that are uncorrelated with the market, is advantageous for any investment portfolio. These investments pay out in the long run and are less prone to market fluctuations. For instance, Yale's endowment fund adopted a strategy that includes uncorrelated physical assets, and between June 2010 and June 2020, it generated average annual returns of 10.9%. Number 2. Omitting a savings strategy from a financial plan. Being ultra-wealthy requires investing, yet many people overlook the value of having a savings plan. UHNWIs, on the other hand, are aware that a sound financial strategy involves both savvy investment and prudent saving. The extremely affluent can therefore concentrate on raising their cash inflows and lowering their cash outflows, which will increase their overall wealth. Although it may not be customary to conceive of the extremely affluent as saves, doing so will help them accumulate their desired level of wealth faster. Number 1. Keeping up with the Joneses. Many smaller investors constantly monitor what their competitors are doing in an effort to improve upon or match their investment approaches. To grow personal wealth, it is essential to avoid getting sucked into this kind of rivalry. The really affluent are aware of this, and prior to making investing decisions, they set personal investment goals and long-term investment strategy. UHNWIs have a clear idea of where they want to be in 10, 20, and even more years. And they follow a financial plan that will get them there. They maintain their path rather than trying to outrun the competition or get anxious about the impending economic slump. The really wealthy are also quite effective at avoiding comparisons with other people's wealth. Many non-wealthy folks fall into this trap. UHNWIs resist the urge to buy a Lexus just because one of their neighbors is doing so. Instead, they compound their investment returns by investing the money they have. They can then cash out and purchase the toys they want once they have reached the required level of money. That's it for today. We hope you found our video interesting. If you did, please give it a big thumbs up and share it with others. Also, if you haven't already, please consider subscribing to our channel. Don't forget to turn on the notification bell so you don't miss any of our new uploads. In the end, thanks for watching, and see you next time.